Welcome, everyone. If you're trying to figure out how global financial systems actually protect themselves or, well, completely fail to protect themselves, you are definitely in the right place. In this explainer, we're going to look right past those sensationalized headline-grabbing numbers we always see in financial crime compliance. Instead, we're breaking down the data, the actual enforcement actions, and the underlying gritty operational realities of anti-money laundering, or AML, enforcement. We'll be doing a bit of a deep dive comparing the UK and France, but honestly, more importantly, we're going to uncover what the data really reveals about how institutions are actually trying to stop illicit money from flowing through the system. All right, to kick things off, let's look at the United Kingdom. Back in 2022, the UK's Financial Conduct Authority, the FCA, imposed a frankly staggering £215.8 million in fines across all their regulatory categories. Just a massive number. And a huge chunk of this was a single $107.8 million penalty against Santander UK for some seriously persistent weaknesses in its business banking AML controls. Now, when you see a number like that, right, it projects massive regulatory muscle. It absolutely commands attention. But then, we look across the channel to France. In that exact same year, 2022, France's principal AML supervisor for banks, the ACPR's Sanctions Committee, well, they issued 3 AML counter-terrorist financing and asset freezing decisions. The combined penalties for all of those? A comparatively tiny 2.35 million euros. Side by side, I mean, these numbers look like they belong in completely different universes. So, staring at those two drastically different numbers naturally begs the question, who is the tougher regulator? Well, I'm actually going to disrupt your expectations right here because comparing annual fine totals is highly misleading. Honestly, it's a total trap. You see, a regulatory fine, a criminal court penalty, an asset forfeiture order, these are legally entirely different outcomes and they apply completely different evidential standards. Ranking regulators by the cash they collect, it completely misses the deeper lesson here, which is that enforcement should be judged by the specific control weaknesses identified and the actual behavior changed, not just the final penalty value. Section 1. Anatomy of AML failures. The reality behind the numbers. Okay, let's dive into this. We are going to pivot away from those flashy headline numbers and zoom in on the true measure of enforcement, operational failures. The cases that wrapped up in 2022 expose control failures that remain absolutely central to AML vulnerabilities today. We're talking about institutions caught accepting customer information without ever testing if it was actually credible, failing to compare expected activity with actual transactions, and literally letting high-risk relationships continue long after the red flag started waving. Take that Santander UK case we mentioned earlier. It brilliantly illustrates exactly what we're talking about here. This whole thing affected over 560,000 business banking customers. So get this, one customer claimed to be a small translation business. They filled out their onboarding forms declaring an expected monthly deposit of around £5,000. Pretty standard. But within 6 months, this tiny translation business was receiving millions of pounds and rapidly transferring the money elsewhere. And here's the real kicker. Even though the AML function recommended closing the account in 2014, internal process failures meant the account stayed open for years. It just proves that expected activity absolutely cannot be a static, check-the-box field you fill out once during onboarding. It has to be a dynamic part of the institution's monitoring logic, because if actual activity diverges this wildly from the declared model, the system absolutely has to catch it. Section 2. Ignored alerts and bad data. Let's look at how modern banking complexities are making this whole thing even harder. Identifying a red flag? That's really just step 1. Today's transaction monitoring systems generate literally thousands of alerts. But think about it. What happens if an alert is just closed out without any real investigation? Or what if the responsibility kind of bounces back and forth between operations and compliance without anyone actually owning the final outcome? What you get is this massive, dangerous gap between detection and disruption, and modern, super complex data feeds are exacerbating these specific vulnerabilities in frankly terrifying ways. Just consider what happens when the system fails entirely. 60 million. That staggering figure right there represents the unmonitored transactions at Metro Bank, valued at over £51 billion. I mean, no way, right? How does that even happen? Well, it wasn't because they didn't have a monitoring system in place. It was actually due to deficiencies in the system's configuration, the data feeds, and how they handled exceptions. Basically, some customer records were rejected just because of basic data quality problems, which meant those transactions literally never even reached the monitoring engine to generate an alert in the first place.
So this brings us to a really critical concept, something called data lineage. It's essentially the tracking of how information moves from source systems into your screening and monitoring platforms. A resilient AML program has to map exactly how that information flows. If there are rejected files, missing fields, or interface failures, those have got to be independently tracked. Metro Bank proved the hard way that a multi-million-dollar transaction monitoring system is, well, entirely useless if the data entering it is flawed. Because of this, regulators are increasingly treating bad data not just as an IT glitch, but as a severe, fundamental governance failure.
Now, you might be thinking, hey, surely those slick, digital-first banks have this all figured out, right? Actually, challenger banks have their own unique set of vulnerabilities. A 2022 FCA review found that in the massive rush to offer seamless, instant digital onboarding, some of these institutions skipped gathering enough income data, or they used risk categories that were just way too broad. They basically assumed that incredible speed could coexist with weak controls. And hey, this isn't ancient history either. Starling Bank was hit with a fine of roughly £29 million in 2024, and Monzo faced a £21.1 million penalty in 2025. Crucially, a lot of these penalties actually involved breaching restrictions that were imposed during remediation. What that tells us is regulators treat violating a remediation requirement just as seriously as the original financial crime deficiency itself. And remember, the risk isn't just about your direct day-to-day customers. Correspondent banking creates indirect exposure without direct relationships. Basically, it allows one bank to provide services to another, meaning they might be processing transactions for people they have absolutely no direct relationship with. The FCA fined Ghana International Bank £5.8 million specifically because they failed to perform risk-based checks on their overseas banking relationships. The main takeaway here? Just because an institution has long-standing status does not excuse you from properly documenting your risk assessments. Section 3. The French Approach Explained. So if the UK is out there handing out these massive multi-million-pound fines to address these issues, what exactly is France doing? Well, while there are separate French agencies like the FFA that handle corporate anti-corruption settlements, the actual AML supervisor for banks, the ACPR, operates very, very differently from the UK's FCA. Now, what's really interesting about this slide is that it reveals the hidden costs of those seemingly tiny fines. A firm like Werha or Crédit Agricole might receive a penalty of under €2 million from the ACPR, but the penalty value isn't a complete measure of the enforcement intensity. France uses a combination of targeted sanctions and super intense supervisory remediation. Think about it. If you are legally ordered to replace your entire monitoring system, refresh all your customer files, hire dozens of additional employees, and conduct a massive historical review of past transactions, well, the reputational and operational costs of all that are going to far exceed whatever that headline penalty was.
Section 4. Building resilient control stacks.
Zooming out from the specific micro-level anecdotes and fines for a second, we really need to talk about where this whole thing is heading. Regulators across both the UK and Europe realize the current system needs some major structural changes, and institutions are going to need actionable, bulletproof solutions to keep up. We're currently looking at a timeline of massive shifts towards supervisory consolidation. Over in the UK, the FCA is absorbing much broader responsibilities, aiming to reduce that tricky fragmentation across different sectors. Meanwhile, the European Union is launching something huge, the AMLA, or the Anti-Money Laundering Authority. They're starting operations in 2025. By 2027, they will select 40 high-risk cross-border institutions, and by 2028, they'll actually take over direct supervision of them. For French institutions, this means ACPR supervision will increasingly operate within this massive common European framework. The neck is definitely tightening, for sure.
So, the crucial point is, how do institutions actually defend themselves in this changing landscape? They need an actionable, bulletproof solution, and the answer is a 7-layer control stack. This is an essential step-by-step roadmap for what resilient remediation actually looks like. Let's walk through it. Layer 1 requires an enterprise-wide risk assessment, but connected to actual customers, not just theories. Layer 2 is rock-solid, reliable customer due diligence. Layer 3, as we learned from the Metro Bank debacle, is strict data governance, so your monitoring is actually accurate. Layer 4 is risk-sensitive transaction monitoring, stuff that actually looks at behavior. Layer 5 ensures you have effective case management for timely decisions. Layer 6 demands strict control and independent approval over high-risk onboarding exceptions. And finally, Layer 7 is high-quality suspicious activity reporting that actually explains the flow of funds. Honestly, this stack is exactly what an evidence-led enforcement response looks like.
To tie all of this together, we have to keep one core truth in mind. which is enforcement becomes effective when it changes those conditions, not simply when the fine is paid. A fine? A fine just tells you exactly where a regulator successfully proved your control environment failed. True, sustainable remediation requires a firm to look in the mirror and ask why. Why was that failure tolerated by management in the first place? Why did it slip past internal audits? And maybe most importantly, is that exact same weakness hiding somewhere else in our systems?
Which leaves us with one final, pretty provocative thought. The next time you're scrolling and see a headline about some record-breaking financial penalty, don't just look at the dollar, pound, or euro amount. Look past all those zeros and ask yourself this. When the fine is actually paid, has the root cause actually changed? Because let's be real, if the data lineage is still broken and those alerts are still just being ignored, the real cost of that failure is only just beginning. Thank you so much for joining me on this explainer. Keep analyzing, always look past the headlines, and I'll catch you next time.